Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in and Fannie Mae has tripled their expectation for home price decline in 2023. And on top of that, are we going to have the second round of inflation? Is the second round of inflation already here? Will the Federal Reserve have to do additional quantitative tightening? Will they have to do additional raising of interest rates? The answer to that, my friends, is yes. And the reason that is, people are still spending money quite foolishly, and people are not listening to the Federal Reserve. The markets right now are going against everything the Federal Reserve is saying is going to happen. To me, that's only making things worse and not allowing us to properly reset the housing market, which is the stickiest area of inflation. If we're to battle inflation and to battle unaffordability, that battle needs to continue in the housing market. Regardless, we're going to jump into an article by Fox News, and I'm also going to pull up some data charts by Black Knight that I think are very relevant to understand fully what's going on right now, which is essentially an unaffordability and inflation systematic breakdown. That's what we have right now. And to fix that, you guys, in order for the Federal Reserve to fix that, a lot of bad things are going to happen. So I really think it's important to see what Fannie Mae is saying, because Fannie Mae, Freddie Mac, you guys, massive institutions. So let's jump into the article right now. Let's see what they're saying. Let's also take a look at some charts to get a better idea of what's happening right now versus what happened in the past, because even though history doesn't always repeat itself, it does rhyme. So remember that. And remember this as well, you guys, I'm not a financial advisor. This is my personal YouTube channel where I get to be honest, transparent, and share with you my beliefs. And I also get to take you guys through my own home buying journey, which unfortunately I may have to take a couple steps back on. I'll cover that a little bit later, you guys, in a different video. But either way, do me a favor, like this video, subscribe to my channel if you haven't subscribed already. Shoot me a comment below and let me know what you've learned, if anything, in this video. And please, guys, tell me what I can do better. What information do you guys want me to report on that will make you stronger and safer buyers? All right, so comment below, but either way, guys, let's get started right now. Now, again, you guys, this is from Fox Business. The name of this article, which will be linked in my description, by the way, as I always do, home prices forecasted to plunge, but U.S. expected to avoid a repeat of the 2008 financial crisis, according to Fannie Mae. We're also going to talk about during this video what will have to happen for house price decline to match or even exceed 2008. And just real quick, I just want to make this point real quick. There are already metro areas that are exceeding the rate of price decline compared to 2008. There are already metro areas right now, Austin, Boise, right now, are already on pace to smash the 2008 price decline. So again, I tell you guys, if there's one thing you get from my videos, it's this: be cautious, be cautious. Number two, follow the data. Number three, do your own thinking. Don't let other people do the thinking. Don't take the easy way out. Ask yourself, what is best for you? Because no one cares about you like you. Either way, let's jump into the article. This will be a brief read, and we'll also be jumping into charts and things of that nature because I absolutely love visualizing data, as you guys know. But here's how the article goes. Fannie Mae's latest economic forecast has predicted home prices will drop by over 6% in the next 2 years, but said the U.S. market is in good shape to weather the decline. Mortgage Giants Economic and Strategic Research Group, or ESR, expected a home price decline of 4.2% in 2023, followed by an additional year and an additional drop of 2.3% in 2024. The anticipated price drops are more than the mortgage giant had previously forecasted at 1.5 and 1.4% respectively. So I just want to point out that they tripled their estimate. So they went from 1.5, 4.2. You guys, that's a triple. So my question is, what do they keep getting wrong? Why aren't they listening? And I believe that is no one feels the pain like the consumers feel the pain. And obviously the consumers are suffering right now, even though we're seeing a whole bunch of spending continue. My opinion is that spending is in credit cards, not money, plus our declining savings rate. So in other words, here's what's important to understand what Fannie Mae is saying. They're saying that this decline is going to last 2 years. So my question is, you guys, will the recent homeowners that purchased at the peak, all right, will they be able to last 2 years of hell? A minimum of 2 years of hell, because remember, if prices go down, they have to go up enough for homeowners to be able to refinance. So will recent homeowners be able to make it through 2 years? And also, will new home builders be able to make it through 2 years of hell as well? I don't think so, guys. I don't think so. We'll take a look at some charts. But one thing by now that should be clear, perfectly clear to everyone, the Federal Reserve is in control. Quite frankly, we can all be wrong and we can all be right. It just really depends on the Federal Reserve. Now, I'm leaning on the Federal Reserve, and I have faith in the Federal Reserve that they will properly reset us. And if they have to force a deep recession, it sucks. I understand. They put us in this situation. But I think they need to do that, guys. I think they need to do that. And again, the reason I think that is you can't price out half the nation. You can't price out half of potential homeowners out of the market. You can't do that. And even if they thought, okay, let's do that, there's still not nearly enough investors to pick up that void. You guys, here's the thing. Unemployment, I guess, according to the numbers, that hasn't even started. Foreclosures, you guys, that hasn't even started. Recession, you guys, that hasn't even been confirmed. National year-over-year price decline, you guys, that still hasn't been confirmed. I believe that's going to happen in March, after February. So as soon as we hit March, we're going to finally start that year-over-year nationwide average price decline. That's going to happen this year. And once these things start to happen, once the truth is exposed on mainstream media, that's when the fear of missing out, like I've been talking about for 11 months, is going to add to the price decline that we are so desperately in need of. But let me show you guys a couple charts, because here's what I want you guys to do. If you really want to follow the housing market crash, there's really a set of data that you should be looking at. Well, I think there's a bunch of data, but if you're only going to look at one set of data, all you guys need to do is watch the 10-year Treasury. The closer it gets to 4%, the more pain and destruction that will happen, well, around the nation, but obviously also in the housing market, not the federal funds rate. The federal funds rate does affect things, but it does not closely match the mortgage rates. The Treasury does. So let me show you a case in point right now. Take a look at these charts. Okay, guys, so here's a mortgage monitor from Black Knight. This is the December report. You guys see that I have a new tool here. I'm really excited about it. It took me forever to figure out how to use my iPad, but here's what I want to show you. Let's scroll down here, and I'm going to show you why we can't really watch the federal funds rate and why we really need to watch the Treasury, the 10-year Treasury. So here's the charts right here, you guys, that I want to reference. I'm going to zoom in here a little bit. Okay, let's start over here. Okay, so here's the federal funds rate versus the 30-year term, okay, or Freddie Mac's 30-year fixed rate average, let's say, okay? And here's what I really want to show you. So the federal funds rate is the dark blue, you guys, and the mortgage rates is the light blue. And really there's just kind of one area that I want to show you, and I think that this will hit home. So I want to note that around this time here, if you guys can see, in 2004, all right, the federal funds rate shot up, all right? So that federal funds rate shot up, but look at the mortgage rates. So the mortgage rates stayed the same. They stayed flatlined right there. So even though the federal funds rate went up, the mortgage rates essentially did nothing. Y'all see what I'm talking about here? Now, obviously, if we kind of look at this area right here, the federal funds rate kind of matches per se, what's happening with mortgage rates. But it's really kind of not matching as well. So I just really wanted to point that out, guys, because the federal funds rate is not really something that we can watch. And let me show you, here's the title, Federal Funds Rate versus 30-year fixed rate mortgage. So it's not really something that we can watch to get an idea of what's happening with mortgage rates and affordability per se. A better indicator is the 10-year Treasury. Let me show you. So if we zoom out right here, we go over here. Let me zoom in. So obviously, as you guys can see, 30-year mortgage to the 10-year Treasury spread. So what I want you guys to basically notice here is look at how these charts match. So the 10-year is essentially matching the 30-year conforming rate almost identically. Do y'all see that? Whereas the federal funds rate, it did have a little bit of following and a little bit of pattern, but not nearly as much as this 10-year Treasury. I mean, you guys can see, look at it. I mean, it matches, you know, this whole thing is essentially matching, right, what's going on with the 30-year fixed rate mortgage. So again, you guys, what I'm saying is this is the information right here that you want to be paying attention to. The 10-year Treasury, not the federal funds rate, although the federal funds rate is also super important. That really has a play on consumer debt, credit cards, auto loans, even commercial financing and things of that nature. But again, if you really want to watch the housing market and see how much pain is coming, just watch that 10-year, and the closer to 4% we get, the more damage and harm will happen. Harm and pain will lead to the ever so important home price drops. That's the inflation we're paying attention to, at least I'm paying attention to. Obviously, eggs and bacon and used cars and all that stuff is important. It does affect everyday life. But I'm talking about the housing market. That inflation is all messed up right now. Let's go back into the article. So back into the article. This is Fannie Mae by Fox News. The rapid decline in home prices is not likely to create a shock for the market as it did during the 2006 to 2008 period, when prices dropped and borrowers walked away from mortgages, flooding the housing market with foreclosures, according to Fannie Mae. Today, fewer borrowers are facing interest rate shocks, except those temporary buy-down people. Am I right, guys? Except for the temporary buy-downs that are surging in the market right now. So are we going to have a foreclosure crisis in 2 years after we're supposed to recover? Or are we going to have 6 years of hell? I don't know anymore, you guys. This data is wicked, isn't it? But again, the one thing I'm looking at, 10-year, I'm looking at unaffordability, I'm looking at the locals. If home prices and those payments, if they can't keep up with wages, it's just not going to work. I don't care what happens, it's not going to work. It's not. Loan workout and modification programs are more robust, and aggregate residential real estate and the broader financial system are substantially less leveraged compared to 2006 and 2008, except with used car loans that are really collateralized by a depreciating asset. So I'll argue actually auto loan and the consumer debt sector is way worse, way worse than 2008. Not to mention credit cards. I'm telling you guys, credit card debt is almost 3 times as high as 2008. Y'all, I'm telling you, the spending in CPI, all the consumer spending that people are seeing right now, that's coming from credit cards. And unfortunately, that's how our society lives. I hate it, guys, and that's why we got to go through the pain. If everyone would spend smart, if everyone was unified, sat this one out, allowed the Federal Reserve to do their job, we wouldn't have to go through so much pain, in my opinion. Let me take this a step further and let's talk about the unaffordability. Let me pull up another chart. All right, so we're back on Black Knight. Let me zoom in here, guys, so you can see this. Now, I love referencing this form. Let me make sure my picture's out of the way. Let me move my picture down real quick here. Sorry, guys. All right, so this is the payment to income ratio for 30-year rates. So this is basically a guide to tell us are homeowners potentially in distress? Can they afford their payments, right? So back in 2008, people went into foreclosure. They couldn't afford their payments, right? I understand that derived from horrible lending standards. Lending standards today, not even comparable. I'm telling you guys, it's not even comparable. People say toxic loans today. It's not even comparable to 2008. But what is worse is homeowners right now have a bigger unaffordability crisis. Listen to me, guys. The unaffordability right now is worse. And I'm going to show you guys real quick. So here's where we were at, okay, right here. So we were at right here, basically right before things got crazy. So right before things got crazy, we were at a payment to income ratio of 33.8%. Y'all, here's the thing. We're higher than that right now. We have a stronger unaffordability problem than we did back before the great financial collapse. We're at 34.8% of household income going to paying off the mortgage. So what happens, you guys? Listen. So what happens when unemployment does go up? And that does show it in the crazy numbers right now. What happens then? I think y'all know what happens then. People stop making their mortgage payment. When people stop making their mortgage payment, we have additional financial collapses. And also that leads to foreclosures, which the article is correct. Loan modification has been a great solution. But the thing is, guys, if these banks can no longer afford to do loan modifications, then they'll stop. They'll start foreclosing. They'll try to sell the properties, especially if there's equity still in the properties. If there's equity in those properties, like almost everyone has equity right now, these banks aren't going to play ball. And then what if there's bank runs? You guys, I know it sounds crazy, but remember, through the Dodd-Frank Wall Street Reform Act, bail-ins are legal. Bail-ins are legal. A bail-in is when a bank is under financial distress and they pull money away from their depositors. What if that happens? Think about it. This is absolutely crazy, but let's jump back into the article. And this is the end of the article. Recession still in the cards. Fannie Mae revised its 2022 gross domestic product growth estimate to 0.8% from 0.4% due to stronger incoming indicators. Does that mean they're seeing our second wave of inflation? And here's the thing. If it's me and I see a second wave of inflation, I'm hitting the panic button. I'm hitting the panic button because that means they're going to have to give us even more pain, because what they're doing right now, it ain't working. You guys, what the Federal Reserve is doing right now, it ain't working. It's not working enough. We have had a massive change in the housing market, so I'll give that credit, but it's not enough. Let's finish. Despite the year ending with more robust growth than initially forecasted, Fannie Mae said it still expected a modest recession to start in the first half of 2023, and it is anticipating a contraction of 0.6 in GDP growth in 2023, down 1/10 from its previous forecast. Consumer spending remains unsustainably high relative to disposable income. Do you guys see? We have a credit card and spending crisis in America. That is a fact. That is a fact from the data. We know that. Don't forget. Supported by consumers tapping into savings built up during the pandemic period and taking on debt. We know this. We know people are spending their savings to survive. We know people are getting in credit card debt to survive. We know the credit card companies are making an absolute killing right now. While it is difficult to determine the exact timing, we believe it is only a matter of time before consumer retrenchment helps drive an eventual general economic contraction. So they've revised their projections based on them viewing that we're going to be in a short, shallow recession. But I'm saying, you guys, we can't possibly be in a short recession because the inflation in the housing market is too sticky. Things are too unaffordable. That specific inflation and unaffordability is what we really need corrected. And again, in order to do that, a lot of pain is going to happen. Unemployment, companies going out of business. It is really sad. And that's why I keep trying to prepare you guys. That's why I'm so passionate. That's why I'm so sensational, so that you guys listen, right? Don't jump in. Don't be like the sheep. Don't be like the sheep is my point. The thing is, guys, again, I believe we're going to have a deep recession. I believe we're going to have a recession. Now, one of the things that we can use to determine an incoming recession, and this has been used for decades, is the yield curve inversion. Every time the 3-month Treasury has inverted over the 10-year, it's led to a recession. And you guys, we're inverted right now, and we've been inverted for quite some time. But real quick, guys, let me pull up a chart so that we can see exactly what I'm talking about. All right, guys, so here's the 10-year Treasury constant maturity minus the 3-month Treasury constant maturity. So when this blue line goes under the black horizontal line, that represents inversion. All right, that's what represents inversion. Now, I also want to point out that these gray Vertical lines represent a recession. So as we can see, now this is only going back to 1985, but we can see that it inverted around 1989. Shortly after the inversion, it led to the recession of the 1990s. Now fast forward over here, we had another inversion, during the middle to end of the year 2000s. Shortly after the inversion, it led to recession. Again, it happened here mid 2006. So again, all of the people, including me, that lost their houses, if I would have paid attention to these leading indicators, these economic indicators, maybe I could have avoided foreclosure. Maybe I would be a millionaire by now, but I didn't understand it back then. But as you can see, they had warning in 2006 what was coming. Now, obviously, shortly after the inversion, it led to recession. Now, here as well, this is crazy. All right, so it inverted again. Mid 2019, we actually had a recession in 2020. Now look at this. It's inverted right now. It inverted around Q4 of 2022. And look at the depth of the inversion. Now I know the depth of the inversion doesn't necessarily signal a deep recession, but it surely does not look good. But look at that, guys. Look at the depth of that inversion right there. So what's going to happen next? Obviously, there's probably going to be a U-turn, and we're probably going to be in a recession. Only time will tell. But one thing is for sure, tread lightly. So in conclusion, you guys, I understand that we're going through a time right now where everyone wants to go back to purchase. But I just want to point out, the same thing happened in 2007. I was a victim of my bad decisions. My bad decisions and me keeping my head in the sand led to foreclosure. And I was an expert. You guys, I was doing circles around people. I was incredibly successful at a young age, and still I kept my head in the sand. And I see the same thing happening right now as far as real estate. So I really want to encourage you guys, stay cautious. All right. Maybe you don't think the housing market is going to crash, but at least do me a favor, stay cautious and learn what a great deal looks like. Now, other than that, guys, I really appreciate you following along with me on my journey. And I really hope you guys got some value, insights, and perspective. And if you're out there investing in real estate, I wish you luck and I hope you win.